Trick or treat might be coming in March. And Powell might be the one either tricking or treating. And that means this March 22nd FOMC meeting, likely the reason for a slightly more sedate, not in terms of volume, but in terms of range and volatility, options expiration Friday. We are just 3 days away, 3 trading sessions away from a decision about not just the March rates, but also, do we as traders and investors have the messaging right? Is Powell really going to be as less hawkish, as accommodative as the Fed fund futures look right now? Let's take a peek at those before we dive in. For those of you that don't know me, I'm Raghee Horner, lead trader at the Simpler Futures site, as well as the Sector Secrets Mastery. Let's take a look at what Fed fund futures and the target rate probabilities look like. The story is not necessarily what's going to happen with the March meeting. That's pretty much set. Although, tell you what, whether or not we end up at 4.5% and 4.75%, or 4.75% and 5% right now, we're clearly favoring this outcome. That's not the real story. We're going to get a rate hike. The question is, where do we peak? And peak is also known as the terminal rate. So peaking is, where is the Federal Reserve going to stop hiking? Now remember, just a week ago, we think back to the 7th and day 1 of the Humphrey Hawkins testimony, we were sitting at about 6%, 575 to 600 basis points. So this is a dramatic shift since the SVB narrative hit the regional banks in the financial sector. Big adjustment. Did we over-adjust? Well, there's a couple ways we can think about over-adjusting. One is, where has the Federal Reserve kept rate expectations? And I'd say the average since the time of hikes has been around 5%, sometimes up at 5.25%, sometimes way down at 4.75%, right? That kind of area, but mostly around this 5%. So you can see that that's really right now, we are below that level. Course correction will come mostly in the form of the press conference, not necessarily the rate statement. And if there's going to be an abrupt course correction, it's going to be March 22, probably the reason for this very sedate options expiration date. The funny thing is, we get out into July, this is where things get really crazy. So if we peak in May, we're already looking at a potential hold or even cut come June, and come July, this is absolutely factoring in a cut. It's just of how much. So this is a huge difference because, again, going back to that day 1 of Humphrey Hawkins testimony and that prepared statement on March the 7th, 6% was only half the story. We were actually not even then expecting a cut until the early part of 2024. So imagine, this is a far different view merely because of SVB and contagion concerns and the sell-off in regional banks that affected the big four, that affected stocks within the XLF ETF. Really important to think about what the XLF actually looks like in comparison to SVB, Silvergate, and other regional banks. This is Berkshire Hathaway, JP Morgan, Bank of America, Wells that went down sort of with that KRE move, with that SVB move. KRE, of course, the regional bank. So think about all of that and what Powell is likely going to say. If he stays really what would amount to being far less hawkish, equity markets are going to rally. Bonds are going to rally. This is then, that's it. If we're going to see this much accommodation, off to the races. Stocks still love cheap money, gang. They don't like panics. They certainly don't like bank runs, but they love low percentage rates. They love cheap money. I would also make sure to keep an eye on ITB and XHB if, for example, Powell were not to course correct this. My expectation based on where Powell has been comfortable keeping rates is, let's look for a pretty abrupt course correction, especially during the press conference, which is going to then give us pullbacks. All right. So this is the scenario. Now the question is, where do we want to focus on those pullbacks? Picking bottoms in XLF? No way. Picking bottoms in the S&P and the Dow futures or even the XLV? No way. The best place to likely, I don't want to say hide out, but focus on would be tech. Tech has no financials waiting. Clearly, tech will be influenced by risk aversion, a desire not to be in equities. But if there is a strong corner of the market, it's the NASDAQ via the QQQ. It's the SMH. It's names like Taiwan Semiconductor and NVIDIA, AMD, AVGO. It's names that are above their 200 period exponential moving average, right? So these are things we want to keep in mind going into next week if there are buy the dips. But what about sell the rips? Pretty easy. Let's go on back to XLF. Let's go on back to KRE. Let's go on back to XLV. Regional banks, financials, and healthcare. Transports have been struggling. Industrials have been struggling. The Dow has been struggling. So there are plenty of places to sell the rip. It's going to be more focused on financials and healthcare. There are plenty of places to buy the dip. That's going to be the NASDAQ. So depending on what Powell brings us next Wednesday afternoon, the Wednesday aftermath of the press conference is going to definitely set the stage for two things. Whether or not we're looking to buy the dip or sell the rip, and whether or not we're going to see a very volatile end of quarter. Think about now, folks who are managing money, large sums of money. Where do they want to be? That is going to be definitely determined by how hawkish or less hawkish Powell is going into the 22nd. So the reverberations are going to be significant. This is just a look at how I'm measuring them and where I'm looking. NASDAQ futures. I'm also looking at potential opportunities to buy crude oil futures. I'm also looking at potential buy the dips in bonds and in gold. So there are cool futures contracts to keep an eye on, but the NASDAQ is definitely the one that I've got in the radar because, again, healthcare financials, not a concern for the NAS. All right, that's what I'm taking into the weekend. I will see you all for the Raghee Report on Sunday, 6 p.m. right here at the Simpler Trading YouTube channel. And then we'll go into next week with a shorter time horizon. If you caught the video that I recorded on Tuesday called 1 to 3 days, that's exactly what we're going to continue to do Monday and Tuesday and even Wednesday morning. Let's day trade. Let's stay nimble. Let's keep our time horizon quite tight. Let's keep an eye on the 1 hour structure and daily price movement ranges. That way we have the option to be flat going into the FOMC, and then we can take advantage with a fresh set of eyes what it is that Powell's going to give us. Trick or treat from Powell comes Wednesday. I'll see you in the next update. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.